Hey, welcome back. In the crypto world, it is so easy to get swept up in the hype, right? The crazy price charts, the Twitter noise. But today, we're going to cut through all of that. We are popping the hood to see what actually makes a crypto project run, or, completely run out of gas. This is all about tokenomics. And trust me, understanding it is one of the most important things you can do.
I mean, how perfect is this quote? It just nails it. So many people jump into a crypto because it looks flashy, the marketing is slick, but they never bother to check the engine. And in crypto, that engine is its tokenomics. If that engine is weak, or worse, just fundamentally broken, it really doesn't matter how shiny the paint job is. You are not going to get very far. So that's our mission today. We're asking, what is really under the hood? We're going to run a full diagnostic check, piece by piece, so you can learn how to spot the difference between a high-performance machine and a lemon that's just waiting to break down on you.
Okay, first things first, we have to start with the basics, the spec sheet. You can think of this as the blueprint, the actual DNA of a token. This tells us exactly what we're dealing with from the get-go.
So what is this thing called tokenomics? Well, it's pretty simple, really. It's just the economics of a token. It's the rule book. It governs everything. How many tokens will ever exist, how they actually get into people's hands, and crucially, what incentives are built in to make people want to hold them or use them. It is the entire economic design all in one place.
Now, before you dive into anything complicated, every single analysis has to start with these three core numbers. First up, total supply. What's the absolute maximum number of tokens that can ever be created? Second, circulating supply. How many of those are actually out there on the market right now? And finally, market cap, which is just the price times that circulating supply. Without these three numbers, you're basically flying blind.
And this just sums it up perfectly, doesn't it? The daily price chart, that's just noise. It goes up, it goes down, it's chaotic. But the tokenomics, the actual economic structure behind it all, that's the signal. That's what can give you a clue about whether there's any real long-term potential.
Okay, so we've checked the engine's blueprint. Now let's move on to the fuel system. What actually gives a token its value? What drives the price? Well, it all boils down to two very simple, very powerful words: supply and scarcity. And honestly, this is the easiest way to think about it. Imagine you're at a farmer's market. If there are only a few baskets of amazing tomatoes and everybody wants one, what happens? The price skyrockets. But if a dozen trucks pull up and flood the market with tomatoes, the price crashes. Crypto isn't some kind of magic. It follows the exact same basic laws of economics. So projects tend to use two main types of fuel. On one hand, you've got your high-octane fixed supply tokens, like Bitcoin. There's a hard cap of 21 million, period. That means it's designed to be scarce, kind of like digital gold. Then you have the low-grade inflationary tokens, like Dogecoin, where new coins can be created forever. This constantly dilutes the existing supply, which can make it much, much harder for it to hold value over the long term. Now, here's where it gets really clever. Smart projects can actually engineer scarcity. They can do this through something called burns, where they literally destroy tokens forever to shrink the total supply. Or they can use halving events, like Bitcoin does about every 4 years, to slash the rate of new supply in half. This creates a predictable and powerful supply shock. All right. Engine specs look good. Fuel systems seem solid. But now for a really critical question. Who actually owns this car? Who holds the keys? This is all about token distribution, and you have to pay attention to this. Just take a look at this chart for a hypothetical project we'll call Risky Coin. See that massive chunk? 60% is held by insiders and big venture capitalists. This is a gigantic red flag. It means a tiny group of people control the vast majority of the supply. They could crash the market just by selling whenever they feel like it. Meanwhile, the public, the actual community, only owns a tiny 10% slice. That's a huge imbalance of power. So here's your practical checklist. Go to a block explorer and look up the top wallets. Do the top 10 hold a dangerous amount, say more than 20 or 30%? How many tokens does the team have, and what's the unlock schedule? Can they just dump them all at once? And this one's huge. Is the liquidity locked? This means the project's main funds are secured, preventing the founders from just pulling all the money out and vanishing. That's the classic rug pull.
And this quote just hits the nail on the head. A project can go on and on about being a decentralized revolution, but if a handful of wallets hold all the power, it's really just a centralized system wearing a clever disguise.
Next up, let's talk purpose. What is this token actually for?
Is it a high-performance race car built to do a very specific job? Or is it more like a flashy parade float designed mostly for looks and community spirit?
This table really breaks it down. On one side, you have utility tokens, like Ethereum. They have value because they solve a real problem. You need ETH to pay for transactions and use apps on its network. Its value is driven by adoption. On the other side, you have meme tokens, like Dogecoin. They get their value from culture, community, and attention. Their value is driven by hype. Now, neither one is inherently better or worse, but you absolutely have to know which game you're playing.
But here's the secret sauce. The most resilient, the most successful projects, they manage to be both. They're a bakery, providing something essential and useful that people actually need. That's the utility. But they're also a bandstand, creating a fun culture and a strong community that people want to be a part of. The utility pays the bills, but the culture is what fills the stadium.
Okay, we're at our final and maybe most important section, the safety check. This is where we learn to spot the lemons and the outright traps before you even think about putting any money down. So you're scrolling online and you see a project promising 1,000,000% APY.
Yeah, just run. It is always a trap. Rewards that high are completely impossible to sustain with any real revenue. All it means is that they're just printing worthless new tokens to pay you, and the whole system is designed to collapse the second new money stops flowing in. It's pure poison coated in sugar.
And here are a few other quick lemons to watch out for. A vague white paper, that's the official project plan, that's just full of marketing buzzwords instead of hard numbers. Unlocked liquidity. We already talked about this. It's the classic setup for a rug pull. Sketchy taxes on buying or selling that seem to change all the time. And of course, a few giant whale wallets that can control the price.
So, at the end of the day, it all comes down to this simple idea. In a legitimate project, transparency isn't just a nice little feature. It is a fundamental requirement. If a team isn't being open with their numbers, with their contracts, and with their plans, they are hiding something. Period. And that brings us to the end. So the choice is really yours. Are you going to be the person who gets swept up in the noise, chasing the latest hype coin? Or are you going to be the one who takes a minute, pops the hood, and actually checks the engine? I think we both know the right answer. Thanks so much for tuning in.